You've been lied to, not by a single person, but by a system designed to keep you obedient, confused, and always one step behind. When you were younger, you were told to get good grades, then a good job, then work hard, save what's left. You were told that if you do all the right things one day, life will reward you. But here you are, maybe in your 20s, maybe 30s, maybe 40s, still feeling like you're missing something. Let me be honest with you. It's not that you've failed. It's that you were never taught the rules of the game. Do you remember the first time you got a paycheck? Maybe you felt proud. Maybe you felt free. But soon after came rent, groceries, that loan, that credit card bill. And suddenly, the joy of earning turned into the stress of surviving. And here's the kicker. No one ever told you that income alone is a trap. Not because earning is bad, but because income without allocation is like collecting water in a bucket full of holes. The truth is this. It's not about how much you make. It's about how well you protect, grow, and position what you make. Let me give you a simple analogy. Imagine your money is a group of soldiers. You can either keep them locked in a bunker, safe, but doing nothing, or you can send them to war, careless, chaotic, and they may never return. But what if you trained them, placed them, and gave them missions? That's asset allocation. And yet, it's never taught in schools, not in business class, not in family dinners, not even in most MBA programs. Why? Because if everyone knew how to allocate capital like the wealthy do, the game would be over. The financial industry makes billions from your confusion. Banks want you to keep all your money with them. Stockbrokers want you to trade emotionally. Real estate sellers want you to believe property is the only path. Crypto bros want you to YOLO your savings. But none of them will teach you the balanced blueprint. Let me tell you something personal. I wasn't born into wealth. There was no financial mentorship. I was the first-gen money earner, and also the first-gen money burner. Every mistake I'm about to teach you to avoid, I've made it. And I made it with full sincerity. I saved too much in cash and lost to inflation. I invested in shiny stocks without understanding risk and lost my peace of mind. But then, something shifted. I stopped chasing returns and started building a system that lets money breathe, that gives it roles, rules, and resilience. And once you learn this system, you will never unsee it. So here's my promise to you. By the end of this series, you won't just know how to invest. You'll know how to allocate like a wealthy person, even if you're not one yet. This won't be hype or shortcuts or some buy this now nonsense. This will be the deep, timeless truth, and I'm giving it away for free because no one gave it to me, and I believe that needs to change. Welcome to the beginning of something powerful, something real. Let's start. Let me take you back. I was 24. I thought I was doing well. 3 jobs, my own place, small wins, right? But what I was really doing was burning. Burning energy, burning time, burning dreams, living paycheck to paycheck. But with a LinkedIn profile that looked like I had it all figured out. And then one night, I'll never forget this. I was walking back from a closing shift at a bar, exhausted and numb, and I stopped at an ATM to withdraw some cash for groceries. I entered my PIN. Your balance is $74.38. I stood there, staring, not at the number, at what the number represented, a life of effort, and nothing to show for it. I wasn't broke. I was financially invisible. That night, I didn't sleep, not out of panic, but because I had a realization so loud that it silenced all fear. If I die tomorrow, I won't leave behind an inheritance. I'll leave behind unpaid rent, a used laptop, and 3 pairs of worn shoes. That's when I knew. I wasn't just tired. I was tired of surviving. And that's when it began. I didn't search YouTube for get rich quick. I searched for how does money actually grow. I stopped listening to broke people with opinions and started listening to quiet millionaires who read books, not flaunt cars. I read everything. I read how Harvard's endowment fund allocated billions across decades. I read Howard Marks' letters to investors. I listened to old Warren Buffett interviews most people skipped because they said they weren't exciting. And the deeper I went, the more one truth became undeniable. The rich don't get rich by working harder. They get rich by placing every dollar they earn into a roll. They don't spend their money, they assign it. This part goes to grow. This part goes to defend. This part stays liquid for wartime. This small part takes intelligent risks. They don't just build wealth, they engineer it. And that blueprint wasn't luck. It wasn't talent. It was allocation. You see, most people think rich people got lucky with one investment. But 9 times out of 10, it wasn't a single moonshot. It was consistency in allocating capital like a strategist, not a gambler. They played offense, defense, and risk management simultaneously. It's not sexy, it's not viral, but it's inevitable. So that night, sitting on a secondhand couch with a journal and a pen, I started building my life again. Not with goals, but with a system. Because if your money isn't managed by design, it will be mismanaged by default. And the system I built is what you're going to learn in the next few chapters. Every framework, every filter, every formula. This system changed my life, and it will change yours. Let me say something that might shock you. Asset allocation isn't about money. It's about identity. And that's the problem. Because most people are walking around with money in their pockets, but poverty in their mindset. They ask questions like, where should I invest 10,000 rupees? Which stock should I buy now? Is gold better than crypto? But rarely do they ask, what kind of investor am I? What emotion drives my money? Most people allocate money from emotion, not intention. They don't think in systems. They react in fear. When the market crashes, they run to cash and regret later. When everyone's making money in a hot asset, they FOMO buy at the top. And this is exactly how middle-class people stay middle-class. And here's what most financial gurus won't tell you. You can copy their portfolio. But if you copy it with the wrong mindset, you'll still lose. Let me explain. Imagine a 25-year-old fresh graduate hears that Warren Buffett keeps 90% of his wealth in stocks. He thinks, great, I'll put everything into equities. But he forgets one thing. Warren Buffett has decades of cash flow, billions in backup, zero panic, and unmatched patience. If that 25-year-old loses 40% in a market crash, he might panic sell everything. Same allocation, different psychology. That's why before we touch your portfolio, we need to touch your narrative. The story you tell yourself about money. Let's test it. Do you believe money is security or freedom? Do you believe wealth is earned or inherited or designed? Do you fear losing money more than you crave growing it? Because your answers will drive your behavior more than any course, any book, or any advice ever will. So here's your assignment. Yes, I give assignments. Write your money story. What did your parents teach you about wealth? What experiences shaped your beliefs about money? What emotion rises when I say the word invest? Because until you name your internal noise, you will never hear the signal. Once you write it, sit with it, burn it, rewrite it. You're not just allocating capital, you're allocating identity. You're deciding, from today, I am not someone who reacts to money. I am someone who commands it. Now that your mindset is aligned and your internal story is being rewritten, let me give you the outer system. This, right here, is where the real transformation begins. Most people think the wealthy get rich through one asset: stocks, real estate, crypto, whatever's trending. But that's a myth. True wealth isn't built on a single bet. It's built on allocation, strategic, diversified, intentional deployment of capital across multiple asset classes that complement, balance, and protect each other. This is what I call the Bulletproof Portfolio, and it's not theoretical. This framework is used quietly by sovereign wealth funds, university endowments, billionaire family offices, and yes, smart, everyday investors who've studied the game. Let's break it down into 5 core buckets. First, cash and short-term liquidity, 10 to 15%. This is your oxygen tank when you lose a job, when a medical emergency hits, when markets crash, when opportunity knocks. Put it in high-yield savings accounts, liquid mutual funds, treasury bills, or short-term debt funds. The rule here: this fund should cover at least 6 months of your basic living expenses. It is second, equities, 35 to 50%. This is the engine of long-term growth. If cash is oxygen, equity is acceleration. It includes global index funds like the S&P 500, MSCI World, or Nifty 50, blue chip companies, dividend stocks, equity mutual funds, and sectoral ETFs if you want precision. Why equities? Because they beat inflation over time, because they compound, because they offer liquidity and scale. Third, fixed income and bonds, 10 to 20%. This is your shock absorber. It reduces volatility. It preserves capital. It adds predictability to your life. Includes government bonds, safe and boring, but useful. Corporate bonds, higher risk, higher return. Fixed deposits, PPF, EPF, depending on your region. Bond index funds, debt mutual funds, and even peer-to-peer lending. You may not get rich off bonds, but they make sure you stay rich when markets go insane. Fourth, real assets, 15 to 25%. These are tangible, physical, scarce. They protect you from inflation, currency devaluation, and central bank manipulation. This includes residential rental real estate, REITs, real estate investment trusts, farmland, precious metals like gold and silver, and commodity ETFs. In developed markets, REITs offer inflation-adjusted income streams, especially in healthcare, logistics, and data center real estate. Use this bucket for stability, hedging, and generational preservation. And fifth, asymmetric bets, 5 to 10%. This is where you swing for the fences, intelligently. These are high-risk, high-reward plays. Bitcoin, Ethereum, Solana. But only after research. Startups, through AngelList or syndicates. Venture funds, if you are accredited. Digital assets, royalties, YouTube channels, domains, and AI-powered innovation funds. You only need one win in this bucket to change your net worth trajectory. The rule here: only invest what you can emotionally afford to lose. Let's now turn theory into action. You don't need Lux. You don't need a finance degree. What you need is a calculator, a notepad, and brutal honesty. Step 1. Know your net worth. Take a piece of paper or open a sheet. List down every asset you own. Cash, savings, investments, anything of value. Then list every liability. Loans, credit card dues, EMIs. Your net worth is simply assets minus liabilities. Don't panic if it's negative. Most people's is when they start. We're building from truth. Step 2. Decide your base capital to allocate. This could be a monthly SIP amount like 5,000 rupees or $100, your year-end bonus, or even a one-time investment. No amount is too small. Start with what you can consistently commit. Step 3. Pick your age-based model. Here's a rough structure. If you are between 20 and 30, with a high-risk appetite, 10% in cash, 50% in equities, 10% in bonds, 20% in real assets, and 10% in asymmetric investments. If you are 45 and above, focused on capital preservation, 15% in cash, 30% in equities, 25% in bonds, 25% in real assets, and 5% in asymmetric. Step 4. Automate and allocate. Pick the lowest friction tools in your region. Use mutual fund platforms for SIPs such as Zeroda, Grow, Vanguard, or Fidelity. Automate bank transfers into asset buckets and use apps like Kuvera, Personal Capital, or YNAB for tracking. Remember, wealth isn't built from motivation. It's built from automation. Step 5. Rebalance every 6 to 12 months. Let's say your equities grew faster than bonds. Now you're overexposed. Rebalancing means selling what has grown high and buying underweighted buckets to restore balance. This forces discipline and reduces emotional investing. If these first 5 chapters helped shift your mindset, rewire your money story, and build your first bulletproof portfolio, then part 2 will change how you scale it for life. In the next video, we go deeper into real-world case studies of what goes wrong and why. Middle-class money traps no one talks about. Dynamic asset allocation across life stages. Passive income streams that work 24/7. And the ultimate goal of wealth. Freedom with purpose. Watch part 2. The link is in the description. Save this playlist. Binge it. Study it. Live it. Because in this world, value always wins over vanity. Subscribe, share, and I'll see you in part 2.